Hi, Chris Bertay from Signet Financial. Pardon my bright orange shirts. This is my once per year ode to fashion. I'm actually shooting this video on Thanksgiving, and I came home a little early to discuss what I think is a pretty important subject. A lot of clients have been asking me lately about market corrections and bear markets. It's no surprise the market's been pretty volatile lately, so everyone asks, what do you do? Do you just sell everything and go to cash and wait out the storm? And I could show you several studies on how market timing is a failed strategy, but what I'd rather do is discuss how to create a plan. I think that's the key. I think the key is to know that you have a plan on how to get through that kind of cycle. So you build a framework and you structure your portfolio so that way you know that you have a portion that's in something very safe that you're going to depend on to create your income. And then you have a component that's growth that may go up and down with the market, but you know that ultimately will work in your favor. So many of my clients use their accounts as a source of income. So I think it's important to create that safety net and protect it. So what I'm going to do is in a second here, I'm going to switch to a PowerPoint presentation that I created for my clients just to kind of illustrate how that could possibly work. And what we're going to use as an example is what's known in the financial industry classically as a 60-40 portfolio. That means 60% stocks and 40% fixed income. You can obviously tweak that depending on your goals and circumstance, and you should. But 60-40 is kind of a go-to portfolio for a lot of clients. So what I'm going to do now is just switch over to that presentation and kind of talk you through how you would manage volatility, protect your nest egg, and still create that stream of income that you're looking for. Okay, so what I wanted to do here is just to show you a little presentation on how you can reduce the anxiety around a volatile market. So before I do that, though, there's a couple concepts that I want to walk you through. So the first is a chart of the markets from 1926. Of the past 90 years, you can see that really the markets have rewarded long-term investors. Now, my disclaimer here is, does this mean it'll always do that? No. But historically, as you can see, it has. As a matter of fact, here's the S&P 500. If we look at the pullbacks in the S&P 500, historically they have always rebound. In some cases, by multiples of the amounts that it went down. If we get a little bit more granular and we were to look at some of the bear markets, you can see these are some in recent memories. This is the dot-com bubble in 2001. Here's 2008, otherwise known as the Great Recession. You can see in each instance they've recovered. Again, in some cases, multiples of what they went down, they've recovered a lot more. And the average bull market is roughly about 9 years. And the average bear market is just a little under 1.5 years. So that's the length of time that each of these have lasted. So the last concept I want to cover is how laddering works. Now, laddering is very useful in a rising interest rate environment because basically what you're doing is you're taking bonds at different maturities. So bonds can come due at different times, and you get to choose those times. In a rising interest rate environment, let's say you have a bond that matures in a year. Interest rates a year from now are going to be a lot different than interest rates are now. One way or the other. They're either going to be lower or higher. Many people agree that they're probably going to be higher. So let's say that we take 3 years worth of income. Let's say that we need, let's say that we want $80,000 per year. So let's say we take 3 years worth of income, that's $240,000, and we put it in a short-term strategy. Short-term is 1 to 5 years. In this case, we're going to take 3 years worth of income, and we are going to ladder them. So we're going to stagger them at different maturing bonds. So we're going to take a 3-month, a 6-month, a 1 year, a 2 year. You could even go out a little farther and do a 3 year or a 4 year or a 5 year, whatever you'd like. And as these bonds come due, we're going to make a decision. We're going to look logically at the market and say to ourselves, okay, our interest rates going up? Can we reinvest at 3 months at a higher rate? Are stocks appreciating? Should we put them into growth and capitalize on the appreciation in stock? Or do we have some expenses and we need to take the cash to live on, or because we have a big expense? I don't know. But either way, we're rationally and logically looking at the market and making that decision. And we're doing that every time bonds come due. So that way we perpetually have income coming due to do with as we will, whether that's to pay our bills, to reinvest at a higher interest rate, or to put in growth stocks. Okay, so let's look at an actual example. So let's say that you have $1 million portfolio and your goal is $80,000 per year. So short term, we set aside 3 years worth of income. So this is a 1 to 3 year strategy that we're going to put in bonds. And as you can see, 3 years at $80,000 per year is $240,000. Intermediate term, we're going to do a bond ladder of 1 to 10 years. And then long term is going to be 10 plus years that we're going to put in a growth strategy. So we're going to do stocks. Now, these are just some hypothetical yields. So let's say in the short term, we can get 2.2% over off that portion of the portfolio. Intermediate term, we can get 4.2%, and then long term, 4.5%. So that means that if we do nothing, we know that between dividends and yield, our portfolio is going to give us $39,000 per year. Now, that's less than the $80,000 that we need. So where does that come from? Well, let's take two scenarios. Let's take a very favorable scenario. Let's say the market goes up 10%. That means that our stocks have appreciated 10%. So now we have $60,000 in appreciation that we simply just sell to get the extra $41,000 we need to yield 80,000. So that leaves $39,000 to do something else with, so we can put it into stocks to continue that appreciation. If we think that the market's at a high or we're fearful, we can put it into short-term bonds in order to take care of the rising interest, in order to take advantage of the rising interest rates, or maybe intermediate bonds, or maybe you just need some extra cash, so you take the extra cash for additional expenses as you need. Either way, we made the money we need, and we had another successful year where we paid our bills. And we even got a little appreciation from there, so now our portfolio value is $1,019,000. So let's go the opposite way, because as much as I'd like to think that the market's going to do that every single year, the reality is they're not. So let's say that the market goes down 20%. So now your stock didn't appreciate. They actually went down to 480,000, down from 600,000. Your short-term and your long-term intermediate bonds stayed the same, and they still yielded what you needed them to yield. But now you only have $33,600 worth of income. So since you don't have the appreciation from the stocks, where does that money come from? Well, remember, we have $80,000 coming due every single year from our short-term bond ladder. So we simply take the money that's maturing from there to pay our bills to get our $80,000. Now we still have $30-some thousand from this $80,000. So what do we do with that? Well, we look at the market. Did interest rates go up? Do we want to put it at the end of this short-term bond ladder? Do we want to put an intermediate term, or do we think that the market is ready to rebound and we want to put it into long-term growth? Do we need the extra cash for living expenses? I don't know. We're looking at it though, and we're making a decision. And the bottom line is we're giving this time to appreciate again. Now, if we remember from our previous slide, the average bear market lasts about a year and a half, and we have 3 years worth of income in here. So we are hanging tight with our income here while this appreciates. So this gives you permission to hang tight, get the income you need from your portfolio, and still get the long-term appreciation and wait out the bear markets. Now, some people are more fearful. Maybe you want more than 3 years worth of income. Maybe you want 5 years worth of income in here. That's just fine. But when the market rebounds, then what we do is we take the money from the long-term strategy, replace the short-term bond ladder, and we keep this perpetually going. So that gives you the income you need until the market rebounds and you stayed invested and you managed to wait through the volatility. I hope that was helpful. It goes without saying that everyone is unique and has different situations, so it's impossible to say what works for one person works for another, or that there's one right way to do it, because there's not. There's two keys to it though. Number one, to make sure that you have identified what your goals are and what you're looking to do. And number two, to make sure that all of your accounts are being looked at as a whole and not in isolation. And by that I mean is sometimes I run into clients that have several different advisors or investment managers who are each doing their own thing. So it does you no good whatsoever if they're not talking to each other and they're each running their own strategy. You need someone or a firm to coordinate everything for you to make sure that it's all working together. So again, I hope that was helpful. Happy Thanksgiving. I know it's probably well past Thanksgiving at this point, but check us out on YouTube or visit us on Facebook where we post a lot of information and content about everything from finances down to life. So thank you for listening, and I hope to see you in the next video. Take care.